What's up, traders? Welcome to today's video, how to become a retail market maker in option. If you've ever bought an option that expired worthless, you're not alone. Today I'm going to flip your mindset and show you how to trade options like the pros, like the market makers. And so if you're interested in generating regular monthly income from selling options and you want to stop gambling on them and instead learn how to sell options to the gamblers and profit in any market environment, whether that's a bull or a bear market, then stick to the end of this video and I'll show you how you can do this live with me every day. And before I show you how market makers operate, first let's just start with the big problem. How most retail traders approach options. They're buying out of the money calls and puts, hoping for big moves. They're paying inflated IVs with no edge. They have no system, no risk controls, and no consistency. Whereas market makers do the opposite. They provide liquidity and harvest premium. They're pricing risk and getting paid to do so. And so how do market makers operate? How do they approach option trading? Well, first off, they estimate a fair value for implied volatility, IV. That's how we price and value option. It's all just an estimate on the future volatility. And they determine those fair values based on theoretical pricing models plus real-world supply and demand in the market. They don't guess market direction. Instead, they are pricing volatility risk. And that's what makes them the house. They provide the liquidity, they take the risk, and they get paid a premium to do so, similar to a casino or insurance company. And so once they've determined what an implied volatility fair value is, they then make a market around their fair values. For example, if on a particular stock they thought the fair value IV was 25%, the market maker may provide quotes to buy that option at an equivalent 24% IV and sell it at an equivalent 26% IV. And they're happy to trade either side because they're managing the risk in a portfolio. They just do this over and over again and profit from capturing that spread. That's called providing liquidity. And so to understand how the order book works, there's two different types of participants in every trade. There's a liquidity provider, that's the market maker. They post resting bids and asks in the order book and wait to get filled. And to do that, they use limit orders, which us too as retail traders can also use. Then there's the liquidity takers, which are mostly retail traders. They cross the spread, hit the bid to sell, and lift the ask to buy using market orders. They get filled straight away, but you pay a premium for that speed and convenience. So let me show you how to be a liquidity provider, like a market maker, and not a chaser, like most retail traders. And for that, you've got to understand how the order book works. So let's say, for example, a market maker has determined the fair value for an Apple 200 strike option to be $1. That's the midpoint, what they think the theoretical value of that option is. So they may have some bids in there to buy it at 95 cents and offers to sell it at $1.05. And there may be other bids and offers in the market from other market makers as well. That's what's known as the bid-ask spread, which is 10 cents wide. If you come in as a retail trader and want to buy this option at market, you may pay $1.05. If you then turn around straight away and sell it, you'll sell it at 95 cents. You will have lost 10 cents per contract. There's 100 shares per option contract. So you would be at an immediate $10 loss. Whereas the market maker made that $10 from you by buying at 95 cents and selling it to you at $1.05. But us retail traders, we participate on the same exchanges as market makers. We too can use limit orders. So if you wanted to buy this option and provide liquidity and potentially earn the spread, you could come in and bid 96 cents and immediately you would be the best bid in the market, the highest bid. You would be ahead of the 95-cent bid. And then so if another retail trader came in and sold this option, they would sell it to you at 96 cents. They crossed the spread whilst you earned it. That's called providing liquidity by working limit orders into the order book. And that's how market makers operate. They post resting limit orders on every single option contract out there. And so that's how they provide liquidity and capture the spread. But how do they hedge their risk away? If they end up long a bunch of call options and short a bunch of put options, they're effectively long the market. And since they trade with leverage, their exposure could be 1,000% or more. Well, this is the part most traders miss, because market makers aren't guessing, nor do they trade on naked risk. Instead, they neutralize directional exposure with stock or index hedging. And by doing that, they're left with a position that only bets on volatility mispricing and collecting the spread over and over. They're not betting on market direction. Instead, they stay delta neutral, taking zero view on the market so they can isolate the edge in implied volatility pricing. The goal is to sell volatility at higher levels than realized and then hedge your market risk away. And so let me give you a quick example of that. And stick with me here while I run you through the numbers. To give you an example of portfolio delta hedging, let's say, for example, we will short one Apple $190 strike put option contract at $1. And so we can see the current price of Apple is just below $200 a share. So for example, if we sold the $190 put expiring next week for $1, as long as the price of Apple stayed above $190 by expiration next Friday, we would keep that dollar, $100 per contract. But what happens if the market went down a lot next week? Can happen any week. So would Apple likely as well, since it has a strong correlation to the market. And in the short term, what happens in the market has the biggest impact on stock prices. That's why you'll notice your portfolio moves up and down each day day along with the market, as market risk is the dominant risk factor in the short term and what pushes stock prices around. So let's say the delta on that put option is negative 0.35. In other words, there's a 35% chance that option will expire in the money. Well, since we're short the put, we want the stock to go up. That's equivalent of being long 35 shares of Apple, which is actually a positive 0.35 delta because we're short the put option. And so let's just say for this example, the current price of Apple is $200. If we multiply our 35 share exposure by $200, that equals $7,000 in absolute notional long exposure to Apple. However, not every stock has the same volatility as the market. Apple, for example, has a beta of 1.28, so it's about 28% more volatile than the market. The S&P 500 is the default with a beta of 1. So to work out the volatility adjusted market exposure we've got in our portfolio, we take the absolute exposure of $7,000, we multiply that by the beta, and that gives us $8,960. And so that's our beta adjusted delta exposure from our short put position in Apple. Now the current price of the S&P 500 ETF SPY is $564. So we take our beta adjusted delta exposure, divide that by 564, that equals 15.88, round it up to 16. That means we need a short 16 SPY shares to be delta neutral and remove market risk. This is how market makers do it, and how you can just isolate your trade on Apple's relative performance to the market, along with trading its volatility. If the realized volatility is lower than the implied volatility that you sold it at, that allows you to profit in addition to collecting the time decay and being short option. And so what we want to do is stack our edge in both delta, vega, and theta. For example, we can see on my seasonality forecast indicator, on average over the next 21 trading days, Apple does pretty well, rises 13.73% looking back in history from this point going forward. Whereas just going over to SPY, we can see it's only 3.55%. So typically, at this point in time going forward, Apple generally outperforms the market. And we can see that it appears to have already found support relative to the market here, looking at the spread chart of Apple versus SPY, and also my reversal signals indicator just fired off, which is normally pretty accurate like we can see in the past. Most of the time, it lets us know when the market's potentially about to reverse. So this may be a good time to take a bullish position on Apple by selling a put option, working a limit order into the market, making the spread, and then hedging out the market risk with the correct amount of short SPY shares. But deltas move around each day, so we'd have to come back the next day, look up the option chain in our broker of what the current delta is. For example, if the delta moved down to negative 0.4, given us a positive 40 delta, we would then need to work out what our hedge needs to be based on 40 shares of Apple. So we may need to short a couple more SPY shares in order to stay delta neutral in the market. And that's really key to how market makers operate, is they're removing the delta exposure and risk out of their option books. And it's based on this principle that I just explained to you here. And that's how they stay in the game. And so how can you, as a retail trader, trade like a market maker? Well, up until now, there's been nothing like this available online anywhere. You won't find any courses, strategies, or tools helping us retail traders trade like market makers. And that's because it works. They do their best to keep all this stuff secret. But I've just created a product called the Market Makers Kit, which allows us retail traders to trade just like them. I'll teach you all the basics of selling options, managing risk, and pro-level option trading strategies with 9 training modules. Inside the private members area, you can watch all these videos, understand exactly how to sell options, avoid option assignment, how the Greeks work, and I teach 7 different option trading strategies, how you can quantify a statistical edge in the market. And just like market makers, I've also developed a unique pricing model to determine a fair value for implied volatility on any asset so we can spot mispriced options. And that's my custom option IV fair value indicator for TradingView, which tells us a fair value IV for every single stock and ETF around the world. In addition to that, I'll also share access with you to my 28 custom indicators to find high edge setups. These are a list of unique indicators you won't find anywhere else I've developed over the last 10 years, exclusively on the TradingView platform. And that includes all the indicators you see on this chart here: seasonality forecast, the buy sell bands, reversal signals, with access also to my unique fundamental indicators. The stock fair value indicator gives a fair value on every single stock around the world based on earnings expectations and the company's balance sheet and income statement. Also included is all my market analysis indicators and my S&P 500 oscillator, which looks at market internals to determine short-term tops and bottoms in the market with a very high degree of accuracy. And importantly, the Market Makers Kit also includes access to my custom delta hedging spreadsheet, which automatically does for you what I just showed you in the example of hedging the market risk out of Apple. All you have to do is enter your current account value, the symbols you have option positions open, the amount of contracts, and update your deltas each day straight from your broker. And this spreadsheet will automatically pull the last price, work out the beta, and tell you how many SPY shares to short to get delta neutral. And let me give you a quick example. Using Apple again, we enter in the code. For example, if we had one contract and the delta was negative 0.35, the spreadsheet's telling us we need to buy 16 units of SPY so we can get to our target net delta of 0%. That's delta neutral. You go into your broker, you buy 16 units of SPY, you come back to the sheet, update the total SPY held to 16, and the spreadsheet will let you know you've hit your target delta, you're now delta neutral, and you just want to flatten your options book just before market close each day and go home delta neutral each day. You can enter in as many long and short option positions as you like, and it'll automatically work out exactly how many shares of SPY you need to buy or sell to stay delta neutral. It's really important. And this is the key principle of market making. Also included is access to my private chat room, where I share real trades I'm making on a daily basis, along with charts and analysis of why I'm making a particular trade. I'll also share my thoughts on the market volatility. You get direct access to me to ask questions and interact with other active options traders as well. And so you don't have to do this alone. You can become a part of a community of active option traders where we search for mispricings and opportunities together. We discuss volatility, spreads, position sizing, hedging. I do a lot of trading in the VIX and shorting the volatility ETFs as well. And this is not fluff. We're looking for a real edge with proper execution to provide liquidity, just like market makers, while hedging the market risk out of our option portfolios. And so I'd like to invite you to become a part of the founding 300 members. They get a special 50% discount, and spots are filling up quickly. At the time of making this video, I can see there's only 146 spots available as I speak. And so how can you join the Market Makers Kit today? Well, I recommend taking advantage of the lifetime membership option, which is only available for this week only. Just make a one-time investment today, and you can get 50% off that by using coupon code SELLVOL at checkout. And so to learn all about the Market Makers Kit and jump on board today, click the link below this video or head on over to clickcapital.io/MMK. And I expect this offer to close down shortly once we've got all 300 founding members inside. And so this is your chance to get in today and become the house, not the gambler. And stop buying overpriced lotto tickets. Start selling options with structure, edge, and strategy. I promise you'll find nothing else like this online. And if you ever felt like the odds were stacked against you in options trading, that's because they were. But now you have the chance to flip the script and join this special community by securing your spot today and becoming a part of the first 300 founding members before this offer closes down very shortly. Just click the link below this video and head on over to clickcapital.io/MMK, and I look forward to seeing you inside the private chat room soon. Cheers.